All right, what's going on, everybody? Welcome to another webinar hosted by yours truly, Wes Gottesman. I'm a market advisor with TradeZing, but I'm also a full-time wealth management advisor with a major broker-dealer. So if you've been following me on TradeZing, we do a audio room Monday through Friday, 4 p.m. Eastern Standard Time after the market closes. We go over recaps of the day, anything that happened the day prior, and anything on my watch list that is meaningful that I should tell you guys, as well as any ideas. So today we are going over private placements and sophisticated investments. So what is a private placement? A private placement is another word for an alternative investment, or alts. You may or may not have heard alts strategies or things of that nature. And so who is this type of investment for? Well, it's for a sophisticated investor. By sophisticated, they're either classified as an accredited investor, a qualified client, or a qualified purchaser. Oh, sorry, I'm working from home today. It's my dog, Huckleberry. I'm going to close the door real quick. There we go. We're all people around here. We're all real people with real life situations going on. But so a part of being a sophisticated investor, you're either qualified as a accredited investor, qualified client, or a qualified purchaser. Now, an accredited investor is the lowest of the tier. Okay, so they're individually or jointly with a spouse that has a net worth in excess of $1 million. Net worth, including assets, both liquid and illiquid, less any liabilities, excluding primary residence, though, because that's highly illiquid. And then a qualified client has a net worth, including assets held jointly with a spouse of 2.2 million, also excluding the primary residence. And then a qualified purchaser is an individual investor, not anything held jointly with a spouse, that does not own less than $5 million in investments as defined by the Securities Exchange Commission. So some private placements allow for all three types of investors: accredited, qualified client, and qualified purchaser. Some allow only qualified clients, some allow only qualified purchasers. So it just depends on the offering. So if I were to place somebody into a private placement or an alternative investment, I don't need to just go in and be nitpicky about, oh, you got this property, you got that property, you've had this account, that account. It could be known on a reasonably acquired basis, meaning you can just show the client, hey, are you a qualified purchaser? Are you a qualified client? Are you considered a accredited investor based on what the definition is? And they'll be someone of that caliber is usually quite honest with themselves and with you if their actual net worth status. But they do have to fill out a net worth statement of attestation before they can even be presented the marketing materials. So I can't just go around with this private placement fact sheet, for example, where you as an investor cannot request this marketing material or a brochure or anything that describes the investment whatsoever without filling out that net worth statement of attestation. So let's see. Now, what kind of investment would be considered a private placement? So why would someone want to be in that versus stocks and bonds, and what even qualifies it? So there's several different types. So and I'm sure you've all heard these before: hedge funds, private equity funds, real estate funds, venture capital, exchange funds, private credit funds. we'll go over those. But those are the types of investments that are going to be offered as part of the alternative investment category. Now, when looking at these, you have to determine the terms of them. So that will determine, based on those terms, which are going to be most prudent for the client. For example, some of them are completely illiquid for 10 years or so. They can be illiquid anywhere from a week to 10 years. And that's a very, very large disparity of illiquidity. So someone with a short-term time horizon isn't necessarily going to be in something that's long-term. They're going to pick something that's a little bit shorter term. And when looking at the offering, it's going to tell you the name of the product. It's going to tell you the description of the product, the minimum investment amount. Usually, for accredited investors, the minimum investment amount is $50,000, $1 million for others, and then up to $5 million I've seen as a minimum investment. The investor suitability, the liquidity, and then the tax reporting. So all of that is going to be shown to you as you're looking at the different offerings. So if we're looking at a hedge fund offering, and I'm sure you've all heard that it's kind of a buzzword, hedge fund means big money, not necessarily. Big rewards, big risk. That's what you should think about when you think of hedge funds. And I think hedge funds are excellent. So you can directly invest into a hedge fund via private placement. Of course, like I said before, you've got to be qualified for that. So a hedge fund can essentially invest in anything that the fund managers want to, from commodities, meaning commodities would be grains or even heads of hogs or cattle and gold and silver. And then you can also invest in stocks. You can invest in bonds. You can invest in real estate. You can literally invest in anything you want in a hedge fund. They are not tied to the same regulations as, say, a mutual fund would be. So we've discussed mutual funds in prior webinars. They are not nearly constrained to the same regulation. So they have the ability to achieve much higher returns. They can also charge performance fees, which you cannot charge elsewhere. So maybe, for example, the structure of the fees would go like this. The LPs, the limited partners, or the investors, which achieve a guaranteed rate of return of, or maybe not guaranteed, but I take that back. A hurdle rate of 8%. And a hurdle rate means that the general partnership or the general partners, i.e. the fund managers, anybody that works within the fund, will not get paid a dime unless the investors first achieve 8 percentage points of returns. And then, then the next 2% will go to the fund managers, and then the next percentage from there on up to maybe 25% will be an 80-20 split. Anything above 25% will be a 50-50 profit share. So it just kind of depends on the fund. Just think hedge fund investing in anything depends on the strategy. Could be highly lucrative, could be very conservative. Just depends on the one. And then you got private equity funds. So also another buzzword, PE, private equity. Private equity funds invest in, or the firm will go and they will use fund money, investor money, to purchase companies, also utilizing the bank, but they'll go and they'll purchase a company. So let's say my private equity firm, we go and purchase XYZ company, partially using investor funds, partially using a loan from the bank. Okay. So now we purchased that company. Now we're going to make it even better. We're going to add a marketing team. We're going to add a whatever else you would add to a company. We're going to increase the profitabilities to this point, and at this point, we're going to sell it to maybe another private equity firm, or we're going to sell it to some other kind of business owner. We're going to make this amount of profit on there and split it between the investors and then the general partnership. So that's what a private equity fund will do. And they'll do that across multiple different industries and many different companies. A lot of times, those companies will have, those firms will have many different companies underneath their firm that they own. And so the investors will be receiving, very steady, very strong returns as a result. And then you've got real estate funds. So real estate funds is you'll be using investor money to purchase real estate, whether that's existing real estate or developments, multifamily, single family, doesn't really matter. Then it's all housed in the real estate fund. So you might have some that are multifamily focused. You might have others that are development. You might have some that are double objective. So by double objective, I mean you might have some that are purchasing commercial buildings, but then they're also on the side over here building new developments. Two different strategies within the same fund that can be lucrative, and they'll have a very similar structure as what private equity and hedge funds will have. They'll maybe do the first 8% will go to the limited partners or the investors. The next couple percentage points go to the fund. Anything from there on, 80-20, 50-50, whatever it is. And they can also charge a performance fee. They can charge a management fee. They can charge an acquisition fee, which means when they acquire a building, they can charge the investors, okay, anytime we acquire a building, these are the various costs associated with that. We are going to charge you 3%. And that's not coming out of their principal. That's just coming out of what their overall returns are. But if you're guaranteeing a return, then what does it matter? There's also development fees, which can range anywhere from 5 to 7%. There's disposition fees, which they don't usually charge a disposition fee. Those are the fees associated with selling an asset. So that's what a real estate fund would be. Venture capital fund would be investing into a venture capital firm that injects money into startups. So companies that are maybe worth 100,000, injecting money into them, building them up in a way that they can grow into the millions. And the private equity fund gets a portion of their revenue or equity in the company, something of that sort. Got two more. We got private credit funds, which are becoming more and more popular, I've been noticing. So private credit funds are pools of actively managed capital that invest primarily in loans to private companies. And they generate income by investing in loans of private companies. Okay, so it's clearly an income generating fund. I don't know as much about private credit funds as I do others. I have not actually purchased one for anybody before, but you're more than welcome to go take a look at them. I'm going to give you some examples of some in a minute. And there's also exchange funds. Exchange funds are for a very particular individual. So let's say you have $1 million worth of Apple. Maybe you've had it for a while, maybe it was gifted to you, but you've had $1 million worth of Apple. Your capital gain, it's in a taxable account. Your capital gain is $800,000. That's a lot. Your tax liability on that is going to be 15% or 20%, depending on what tax bracket you're in. So you want Apple, you like Apple. If anything were to happen to Apple, you're screwed. You have Apple, you like Apple, but you don't want $1 million of it. Here's where an exchange fund comes in to play. So there's a couple of different companies. Goldman Sachs is one of them. Another with a very unusual name. I can't think of it off the top of my head. but they'll have something called an exchange fund. And what they'll do is you, as the owner of the stock position, will say, hey, I want $500,000 of Apple, but I want to do something with this other 500,000 without incurring any taxes. What we'll do is we'll put you into an exchange fund. And so what that is Goldman Sachs will take your $500,000 of Apple in a tax-free exchange for a basket, maybe 50 to 150, maybe even 300 stocks, depending on the exchange fund, of very strong stocks that that company deems to be prudent and equivalent in value and ability to appreciate in capital. And now, so if you were to look at your statement, now you'll have $500,000 in Apple and $500,000 split evenly between all these different stocks. Now your stock concentration has diminished in half. So now Goldman Sachs over here has $500,000 of your Apple. You have 7 years to tell Goldman Sachs that you want to switch it back. After 7 years, that basket of stock is now yours. Apple is now Goldman Sachs. You have all of these stocks now that are at the same cost basis of what you had Apple as. Cost basis we'll go over in a different webinar. Cost basis has something to do with taxes. It's a much longer conversation. So it's a great way to limit your risk on a tax deferred basis, pretty much. So that's what an exchange fund is. And now, what are the kind of companies that you can expect to see some of these out of? So probably the most well-known company that offers private placements is Blackstone. Blackstone is a huge private equity company. You could call it private equity, real estate private equity company. They have multiple publicly traded REITs, real estate investment trusts. They have multiple private placement REITs. They also have a private credit fund. So that's a couple that we've been offering recently. There's one called Ares, ARES, and they have a diversified real estate 1031 exchange fund. So you can take, let's say you as an investor, you just sold a commercial property, but you can't find another property to put it into. If you give us that, we can put it into the Ares diversified real estate 1031 exchange fund, so that you can defer your taxes on those capital gains. That's what 1031 exchange does. You got Grey Wolf, which they've got an opportunities fund, which is private credit. You got Starwood, which is a real estate investment trust, privately held. There's one called Vinebrook. Vinebrook was interesting, and it did really well. I think it did 77% in 1 year, which is fantastic. Our clients were very happy with it. They owned a bunch of single family rentals out in the Midwest. And it just did really well. It was the right time for it, and it was a fantastic investment. So in a nutshell, on a very broad overview, that is what private placements are. They're sophisticated investments. Another word for them, alternative investments or alts. Feel free to look them up anytime. There's a ton of information about them. It's very interesting. You might get inspired and read a book on how some of these are formed. There's one about Blackstone, actually, called King of Capital. I don't remember the author's name, but highly recommend that one. It's a great book. Will really take you in on a deep dive of how private placements are formed, how they're offered to investors, and how a company like that becomes so huge. Well, that's it for today, everybody. If there's anything else that you need, you can holler at me on Instagram at the West Scoutsman or on TradeZing out West. We do these informative webinars twice a month. Be on the lookout for the next that you'll find it very interesting. And also be sure to tune in to my audio room every day, Monday through Friday, 4 p.m. Eastern Standard Time after the market closes. It'll be excellent. Don't want to miss out. Have a good one, everybody. Bye-bye.